Good morning from bone-chilling but sunny Chicago, where the 9-4 Chicago Bears will be playing the Cleveland Browns at Soldier Field at noon today. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Follow Me the Money bi-weekly podcast. Today's date is Sunday, December 14th, 2025. In today's podcast, our focus is on the benchmark S&P 500, which has risen by an incredible 43% from the April lows, but it has been drifting sideways for the past 2 months as it negotiates formidable overhead resistance at 6950 to 7,000. The next significant directional move in the broad market index, either up or down, is likely to begin from its current trading range, which is bordered by 69.20 on the upside and 65.50 on the downside. If you recall, right before Thanksgiving, we had a big move down. It stopped right at that support at 65.50, and that was really the start of the current rally we're in now. Our tactical models are still positive, but there is still an increasing number of relative performance relationships that are telling us the market is weakening internally, which, unless this changes between now and the end of the year, would likely result in a very overdue corrective decline. Before we get into our latest charts, data, and updates on our own models, here's some information about us. First of all, I just wanted to say thanks to everybody who took advantage of our Black Friday sale, both for our premium research and also for our entry-level Substack newsletter. We had a huge response to this promotion, and we're looking forward to working with everyone so they can better understand and implement our data-driven strategies and models into their own portfolios. Excuse me. Asbury Research is a registered investment advisor. We're an RIA. We've been providing both investment research and access to our 4 model portfolios via managed accounts to both individual and professional money managers since 2005, which makes this our 21st year in business. We have 2 levels of research service available. We have our Asbury Premium for more serious investors, which includes the latest updates on all of our models and some personal instruction via Zoom on how to implement them and our strategies into your portfolio. We also have our entry-level Substack newsletter for $25 a month, which is right here. It's asburyresearch.substack.com. Does not include any of our trading models, but offers selected reports and models from our premium research product at least 3 times per week. In that, we have a special model that is just for the Substack. It's called the Sort Report. You're actually looking at it now. We'll get into that in just a few minutes and tell you a little bit about that. There is also a free version of the Substack newsletter. So if you like our videos, if you like our approach to markets, if you follow me around the internet as I get interviewed by Schwab and Fidelity and IBD and other places, I strongly suggest that you sign up for the free version of the Substack. It's a no-brainer. It's just more free information from us, and you could do that right here at asburyresearch.substack.com. We also have managed accounts. Let's go back to our premium research landing page, asburyresearch.com. Individual investors, financial advisors, and RIAs can also access Asbury Research models and model portfolios via managed accounts or SMAs. They're separately managed accounts. They call them SMAs. They're available through Charles Schwab. Financial advisors and RIAs can also access our portfolios through a TAMP, which is an acronym for a turnkey asset management platform. 3 of our 4 models are currently outperforming the S&P 500 year to date. This is through the end of last week. All of them have smaller drawdowns, lower standard deviations, and lower betas. Basically, what we do really well is market performance with a lot less risk, which if you're an older investor, that is important to you. And if it's not, it should be, because drawdowns can really do a lot of damage to us when we're in our 60s, we're in our late 50s, because time, just like playing football in the fourth quarter, time starts to become a very important ingredient on how well we do. Um, the fourth model, our Asbury ultra conservative model, is meant to bridge the gap between a short-term Treasury yield, which right now is about 3.75%, and a buy and hold S&P 500, which is about 13.5% on average over the past 7 years, but with absolutely no downside protection, which again, drawdowns can really hurt us as we get older. That particular model is trailing the S&P 500 by less than 5%. Year to date, annualized, it's more like about 3.5%, but it's only had a max drawdown this year of 6% compared to 19% drawdown for the S&P, which we all experienced between February and April of this year. Okay, that's enough of that. Let's start looking at markets, which is why you're here. So we're going to move over to the research center, and this is behind the paywall, and we're going to have a look at our Asbury 6. So the Asbury 6, most of you know, is a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected via quantitative backtesting. Every individual indicator has an Achilles heel. Nothing that I've ever come across in 43 years of doing this works all the time. Different market conditions make certain indicators very effective and others pretty ineffective. So what we did was we put 6 very different indicators together, and it helps to keep us on the right side of the market most of the time. Think of the A6 as a daily EKG for the stock market. I want to know every little wiggle. The A6 is currently, as you can see here, it's 5 of 6 are green. Green means positive. The A6 has also been blinking for the past month, which means it's been rocking back and forth atypically between green, which is positive, and red, which is negative. It indicates that this is a tactical decision point for the market, and these tactical decision points also often become a springboard for the next sustainable trend. We're going to take a look at the S&P 500 in just a second. We're going to show you exactly what that looks like. As long as the A6 remains 4 or more green to retain the positive signal that we've had since November the 26th, you can see it right here, the stock market is likely to remain steady to higher in the weeks ahead. However, another shift to 4 or more red would warn that the current rally has failed and we could be going into some kind of a corrective period. Next thing, let's go back to the research center and we're going to scroll down to keys to this week. Keys to this week is one of our standard reports. This is from Thursday, December the 11th, so it's pretty recent. What the keys to this week is, once a week, Jack and I probably look at 100 charts, 125 charts, and we pull out 10 that we think are the most critical and influential to what's going on in the market right now. So we're going to show you a few of those charts. The first one that I had mentioned, know your levels. This is the S&P 500, and all we're doing here is identifying the support and resistance levels. Ever since the S&P broke out to new highs, I think it was last tail end of June of this year, we talked about an upside target of 69.50 that we had. Well, we got as high as 69.20 on October the 29th. So as far as we're concerned, the target's been met. And so 69.20, then we've got 7,000 is a big round number. The market loves big round numbers, especially when we are at all-time highs, because there isn't really any other resistance level to be found because we're at all-time highs. Down on the other side of the spectrum, we've got all these lows that we made. We got September 17th. We have another small low here that I didn't even identify. That was later on in September. We've got the October 10th and 14th lows right here. And we got down there right before Thanksgiving on November 20th and 21st, stopped on a dime and ran right back to the top of the range. So that's really where all the blinking is going on in the Asbury 6. The market is this is really a distribution period. The market is trying to figure out what it's going to do next. Is this going to be a top, or is this kind of a energy building and resting period from which we're going to go through 7,000 and make the next leg up? The market is trying to work that out. In the middle, we've got some minor support at 67.70 to 67.56. The next thing we're going to look at as we scroll down is this MAGS, or MAGS, as you would guess, is the ETF that tracks the Mag 7, the Magnificent Seven. Paying a lot of attention to this. A lot of the strength that we've had this year comes from the Mag 7 stocks, the AI stocks. So you could see down here, this is relative performance of MAGS versus SPY, which is the S&P 500 ETF. MAG started outperforming SPY on a 63-day quarterly basis on May the 9th. It stayed that way through November the 17th. But look what's happening now. We're starting to ride that 63-day moving average, and we're even turning down under it. Not by a lot, not by enough that you would say that this is definitively a signal, but it's caught our attention here. Keep an eye on how the Mag 7 is doing versus the S&P 500 between now and the end of the year. If MAG starts underperforming the S&P 500, the market has lost one of its key drivers, and that could be problems. The next thing we're going to look at is another relative performance. We're starting to see some relative performance relationships breaking down. The other one that we're watching, well, there's a bunch that we're watching closely, probably 15 or 20. These are the ones that we're going to talk about today. So this is the OEX here up on top, which is the S&P 100. Down here is the daily relative performance of OEX versus SPY, and we're using the 63-day moving average to identify the quarterly trend of outperformance or relative underperformance. On May 13th, OEX started outperforming SPY. Typically, the 100 outperforms the 500 during an uptrend. It underperforms during a downtrend. Look what's happening here. We've got a pretty compelling change in trend here. We don't know if it's going to hold. I can't see the future, and nobody else can either. But as of December 11th, the OEX is now underperforming the S&P 500 on a quarterly basis, and that is a sign of weakness. If this cannot correct itself over the next few days or week or so, history tells us that we could be moving into a corrective period in the stock market. Finally, investor sentiment. Nobody talks about it very much, but I still think it's important. This is the II. This is the Investors Intelligence data. There's different series that they offer. This one is the percent bears. And what we can see is that the percentage of bears is starting to retract from a low extreme of between 16 and 14%, starting to move away from that. These red verticals show that previous times that this has happened, going back to 2011, have all been in and around important market tops in the S&P 500, which is what we're looking at in the upper panel. So this is not a sell signal. This tells us that the market's a little too happy. It's a little too carefree, and often that's when bad things begin. So we need the Asbury 6 to turn back to negative to tell us that it's becoming actionable. But this is just telling us right now the market's a little over its skis, and we need to be careful here. Next thing we're going to look at is sector rotation via our CEF model. So we're going to go back to the Research Center, and we're going to queue up CEF, which is right here. CEF is an acronym. It stands for Sector ETF Asset Flows. And this is what the graphic looks like right now. This is through the end of last week. CEF is currently overweight XLI, XLK, and XLV. That's the top three. Excuse me. Why do we use the top three? Because through a lot of extensive backtesting, we have found that the best returns come from when we take the top three scores. And this is like golf. The lowest scores are the best scores. Basically, we've built an algorithm that measures the velocity of money moving around those 11 sector spiders, which together are the S&P 500. The lowest scores are the ones where the money is moving into that particular sector the fastest. So Industrials is second in the trading time period. It's second in the tactical time period, which is a month. So we have a week and we have a month. It's third in the strategic, which is a quarter. So we have a total score, composite score of 7. So 7, 13, and 14 are our best scores. Those are the 3 that we're in. When that changes, we will follow the money and we will always be in those 3. And we want to stay away from the ones at the bottom because that's where the money is coming from. The CEIF model is always fully invested in the market. It was created to be a dynamic, market-driven alternative to the traditional buy and hold portion of a portfolio. CEIF has slightly outperformed the S&P 500 year to date, but with a lower maximum drawdown, a lower standard deviation, and a lower beta, which means market performance with less risk. Better performance with less risk is very hard to do. It's really kind of the white whale of investing, to use the Moby Dick, the metaphor. For those of you, who remember it, it's about 150 years old, I guess. Since inception in middle 2018, late June of 2018, CEIF has significantly outperformed the S&P 500 on an annualized basis with the same exceptional risk-adjusted numbers. CEIF, something unusual about CEIF. CEIF has posted a positive annual return every single year since 2018. You can contact us for more details on this model or any of our other models by using the contact tab at asburyresearch.com. That's right here. So if you just go to asburyresearch.com, use the contact tab, and we'll be happy to give you more information. The next thing we're going to look at, the last thing we're going to look at, actually, second to last, is we're going to go back to the Research Center and we're going to look at our ETF trade ideas. So we offer many different ways to trade the market. One of these is the ETF trade ideas. And we're going to have a look here. We only have one open idea right now. It's in Ring. Let's make that a little bigger. We put the trade on 11/26. It's a positive idea. It's a long idea. The initial target, 72.74. Valid above 67.86. We like to call this a soft stop. Our outright performance heading into next week, +5. And we're also outperforming the S&P 500 by 5%. These are some of our previous trades. You can see we previously bought Ring down here on 8/6, August the 6th. We got out of it on 10/21, and we made 31% outright, and we beat the S&P by 31% on that same trade. The S&P and gold have been linearly correlated to each other for years. People don't talk about that, but it's just statistics. The nice thing about being in gold this year is they've both been going up, but the outperformance is going to gold. Here's the gist of what we're trying to do here. If you want to build a system for yourself that you can use and that's going to make money for you over time, and it's in the stock picking or the ETF picking realm of trading, you got to have certain ingredients. Number one, you got to have more winning trades than losers. This is 30 months of data, 2.5 months of data, 111 trades, which is about 1 trade a week if you average it out. So our percent of winning trades is 54%. Our average winning trade is 5.4%. We're in those on average about 18 days. Average losing trade is 2.4%. We're in those trades about 8 days. So our winners are more than twice as big as our losers, and we win most of the time. So this is the ingredients for a successful model. If you're an options trader, you can use this data in that way. We have customers that do that. So let's say we're going to buy Ring, and they know that our average winning trade is 5.4%, and we've got, and we're only in these trades for 18 days, which is 3 days less than a business month. You could look for options that only have a month or less till expiration. Most of the value of an option is the time premium that takes that down so it's affordable, and we got a rough ballpark idea of how well these perform over time. So just another way to be able to use our service if you're an options trader. The Asbury 6, the CPM model, the CEF model, and our ETF trade ideas are all part of Asbury Research's premium research service. Again, contact us via the contact tab at asburyresearch.com to request information about service details and pricing. Finally, let's take a look at our Substack entry-level product. And here it is. So once a week, we have a product that is very similar to the Keys to This Week product. It's called Chart Focus. And here it is. This is part of the premium. The free is going to give you one chart. The premium is going to give you a lot of text, a lot of ideas, and a lot of charts as we scroll down. The second part of this is our sort report, which comes out twice a week now for this particular product. And there's sort. The sort report tells us which parts of the global market have positive trends, are outperforming their benchmarks, and have positive asset flows, which means that new money is pushing the prices of these ETFs higher. This is a very low-cost way. It's $25 a month to make better investment decisions based on data, not opinion or economic forecasts, but pure data. Remember, forecasting is a euphemism for guessing. We truly believe in following the money. This is showing us right now that U.S. small cap and U.S. technology are clicking on all cylinders here. The trends are positive according to our model. The relative performance is positive, and also the money flows are positive. So this is a quick way twice a week to be able to look at a wide swath of different investments. I mentioned U.S. small cap, U.S. tech, gold, global equities, U.S. dollar, emerging markets, interest rates, commodities, crude oil, and crypto. Big, wide swath of things you can invest in. It's telling you quantitatively where the opportunities are. So there you go. That wraps up our latest Asbury Research is Following the Money podcast. Our next Following the Money is tentatively scheduled for Sunday, December the 28th. We may push this back a week because of the New Year holiday that'll be coming up. That is yet to be determined, but most likely it will be on Dec 28th. I hope to see you then. In the meantime, if you have any questions or want any more info on any of the research models and model portfolios that we talked about this morning, you can contact us again right here via the contact tab at asburyresearch.com. Happy holidays to you and your family. We look forward to seeing you back here in 2 weeks.